Hello to all the professional traders and loyal supporters of Prime Risk. Today, we've prepared a video that could completely transform how you approach trading. We're diving into one of the most foundational yet powerful analytical tools, order blocks. But that's just the beginning. Not only will you learn how to identify these high-value zones, but you'll also discover how to combine them for more precise and confident entries. If you're ready to take your trades to the next level, more professional, more profitable, and with higher success rates, then stick around until the end of this video. This is where you move from being an average trader to a professional one. Let's get started. First, let's quickly review what exactly an order block is and how to identify one that's worth trading. As you know, many order blocks form in the market, but not all of them are suitable for trading. So, the first step is to learn how to correctly identify a valid order block and accurately mark the zone, as proper marking is one of the fundamental pillars of order block analysis. Order block. When the price initiates a strong trend, there's a surge in buying or selling pressure. This pressure often means that some large traders can't fully execute their orders. As a result, they wait for the price to return to these levels to complete their remaining orders. This is the rationale behind the formation of order blocks and explains why prices react to these levels. Identifying the order block zone. When the price forms a strong trend with 2 or more consecutive candles, many orders are left unfulfilled. For example, in an upward trend, to identify the order block zone, the first opposite-colored candle in the strong trend becomes the basis for the order block. But should you consider the entire candle, just the shadows, or only the body? Different trading styles may vary, but the most optimal zone is from the shadow to the candle's body. For example, in a strong upward trend, if we go back to the start of the trend, the first red candle is our order block zone. The zone is marked from the upper shadow to the body of the candle. If the shadow is very long, though this is rare, you can consider half of the shadow to the body as the zone. If there are multiple opposite-colored candles in a row, you can use the average size of these candles to determine the order block zone. Time frame for order blocks. Order blocks can be found on different time frames, but the 1-hour time frame is one of the best, offering good reliability and frequency. To refine your entries further, you can shift to lower time frames for additional confirmation. After identifying the order block in the 1-hour time frame, switch to the 5-minute time frame and combine it with another powerful tool. Combining order blocks with divergence. To identify divergence, we use the RSI indicator with its default settings. In simple terms, divergence occurs when the price is making higher highs, but the RSI shows lower highs, bearish divergence. For bullish divergence, it's the opposite. The price makes lower lows while the RSI shows higher lows. Entry confirmation. First, we locate the order block and mark the zone, waiting for the price to return to it. Once the price reaches the order block zone, switch to the 5-minute time frame to spot a divergence as an entry signal. For example, if the price is moving downwards while the RSI is forming higher lows, this signals a trend reversal and a potential entry point. Next, add one more layer of confirmation. Candlestick patterns. Personally, I rely on pin bars and engulfing candles. As soon as we see such a pattern, we enter the trade on the candle's close, placing our stop loss below the order block zone. For the target, set it to 1.5 times the stop loss. As you can see, the price moves beautifully towards our target. Another example. First, identify the order block zone on the 1-hour time frame and mark it. Then, move to the 5-minute time frame to look for divergence. Once divergence forms and is confirmed by candlestick patterns, you can confidently enter your position. Important filters. 1. When the price returns to the order block zone, it's better if it does so in a structured way, creating successive highs and lows, rather than a sharp, sudden movement. 2. Ensure that there's a clear divergence within the order block zone. If no divergence forms, or if the divergence is weak, avoid entering the trade. This strategy can be applied across all financial markets because it's rooted in the fundamental dynamics of buying and selling. Once you master it, you'll be able to use it effectively in any market. I hope you enjoy this video. If you have any questions, leave them in the comments, and I'll make sure to answer them. Don't forget to subscribe as we have more strategy videos on the way. Your support means the world to us.